Hey landlords and blessed investors, I'm Nicole Purvy from Better Than Success, and here is your real estate news for May 1st, 2023. FedNow, instant payments or instant fraud. Being able to close on a home at any time and any day of the year has long been a pipe dream. But the Federal Reserve's new FedNow instant payment system looks to be making that dream a reality. However, before one gets too excited, the title insurance industry is asking if it's really worth sacrificing security for speed, according to housingwire.com. There is the obvious perceived benefit of faster payments, and they're touting that it will be cheaper than wire transfers. And of course, you no longer have to worry about missing the 5 p.m. cutoff. But one can't help but to think that this is going to be the absolute rocket fuel for fraud, because you're going to end up with irrevocable payments. Parties can't get their money back. As of now, FedNow is set to launch in July of this year. The platform will be available to financial institutions of every size throughout the United States, enabling users to send and receive payments of up to $500,000, 24 hours a day, 365 days a year. If a home buyer uses the FedNow payment service in their closing process, the home buyer will receive a request for their down payment from their title company. The home buyer then sends the funds through FedNow, and the bank reviews the payment and sends a compliant payment message to FedNow payment service, which immediately validates the payment and passes it along to the title firm's bank, which tells FedNow it intends to accept the payment, and FedNow debits and credits the respective parties. The funds settle between the banks in real time, and users will have immediate access to the newly transferred funds. But while the convenience is tantalizing for an industry looking for ways to streamline and speed up the home buying process, title industry professionals who have been working to battle the increasingly menacing threat of wire fraud see some major risks. One title company expert is quoted as saying, "If you do have a successful wire fraud attempt, the one thing you have going for us right now is that wires can be recalled. Typically, if we catch the wire fraud, it's within the first 24 hours, we have a good chance of fixing it. But with this system, you can't really fix it, because once that money has gone into the system, it's gone forever. Once it's gone from one bank account to the other, then you can transfer right out of the country to an international bank account and it's gone." According to the FedNow website, clearing and settlement occurs almost immediately, minimizing the time frame to detect fraud and stop fraudulent payments from processing. Immediate settlement equates to immediate irrevocability, with funds available for the payee to withdraw. Instant payments operate on a 24/7, 365 basis, giving fraudsters the opportunity to attack at any time. That means that fraud detection must occur continuously, with processes or controls in place to act quickly. My opinion, I don't trust it, and no, I'm not using it for my closings. Economy boosts demand for Airbnb's apartment rental program. In the face of the global economic uncertainty, Airbnb's apartment rental program is seeing a boost in demand, according to foxbusiness.com. In the program, prospective renters can now search for Airbnb-friendly apartment buildings whose policies allow for part-time hosting. In recent months, the real estate market has seen a surge in demand for rental properties, as many people continue to delay their home buying decisions, mainly due to decreased affordability related to mortgage interest rate increases. It's creating a unique opportunity for renters and hosts to take advantage of Airbnb-friendly apartments to help weather the economy, especially the housing market. Airbnb's program launched in November 2022 to help people find apartments where they can host on Airbnb part-time. Since then, it's grown modestly from 175 buildings in 25 markets to more than 250 buildings across 37 markets to address the growing interest. To date, there are more than 3,000 people across 850 cities on a waiting list to be notified when Airbnb-friendly apartment building is available. The program has already served as a viable economic lifeline for hosts at a time when they're feeling squeezed by the high cost of living. Here's a list of markets where the program is available per the Airbnb website: Phoenix, Los Angeles, Newport Beach, Riverside, California, Sacramento, San Diego, San Francisco, Silicon Valley, Washington, D.C., Gainesville, Florida, Miami, Florida, Orlando, West Palm Beach, Atlanta, Indianapolis, Boston, Baltimore, Minnetonka, Charlotte, Raleigh, Cincinnati, Portland, Oregon, Philadelphia, Pittsburgh, Austin, Dallas, Galveston, Texas, Houston, San Antonio, Seattle. My opinion, I don't do Airbnb. It's too much uncertainty. The local level laws and policies don't typically support it, and it's too much risk for me. But if you can stomach it, check the program out. Republican lawmakers move to block FHFA's announced LLPA changes. Okay, let's start off. Here's a recap. Last week, I told you about a new policy where the FHFA will make important changes to their loan level price adjustment matrix, also known as the LLPA matrix, in hopes of addressing housing affordability challenges in the U.S. Allegedly, the plan was to raise the monthly mortgage payments of buyers with good credit scores, where that money will subsidize riskier borrowers who will get more favorable terms because their fees will be reduced. The policy is supposed to start this month, but now, according to Scotsman Guide, the controversial changes have run into a new roadblock: Congress. On Thursday of last week, a group of Republican lawmakers in the House of Representatives, led by Representative Andy Biggs, Republican from Arizona, have introduced the Responsible Borrower Protection Act of 2023. If passed, the legislation will block the amended pricing framework. Now Biggs and other lawmakers have joined the chorus against the fees, with Biggs' group asserting that the new LLPA fees would subsidize mortgage borrowers with lower credit scores beginning on May 1, 2023. With the heightened focus on the pricing framework changes, Sandra L. Thompson, director of the FHFA, released a statement on Tuesday, 2 days before the introduction of Biggs' bill, looking to set the record straight. According to Thompson, recalibrating the fees seems to have attracted a series of recent misconceptions, despite being announced over 3 months ago. Among the misconceptions addressed in Thompson's statement were: 1. Higher credit score borrowers are not being charged more so that lower credit score borrowers can pay less. The updated fees was true of the prior fees, generally increased credit scores decrease for any given level of down payment. 2. Some updated fees are higher and some are lower in differing amounts. They do not represent pure decrease for high-risk borrowers or pure increase for low-risk borrowers. Many borrowers with high credit scores or large down payments will see their fees decrease or remain flat. And 3, the targeted eliminations of upfront fees for borrowers with lower incomes, not lower credit scores, primarily are supported by the higher fees on products such as second homes and cash-out refinances. The enterprise's statutory charters specifically include references to supporting low and moderate income families by earning returns on mortgages for those borrowers that may be less than the returns earned on other products. 33 Republicans have joined Biggs in introducing the Responsible Borrower Protection Act of 2023. So, there seems to be a tale of two LLPAs. It seems that, in fact, the new framework includes several changes from the previous iteration, including increased pricing for borrowers with higher debt-to-income ratios and eliminating upfront fees for certain groups, such as first-time homebuyers with lower income. My opinion, it's giving gaslighting and manipulation to me. The media outlets and some opposers are trying to manipulate the conversation. With the new pricing structure, they are associating borrowers with higher DTI ratios with borrowers with higher credit scores, and they're associating first-time homebuyers with lower incomes with borrowers with lower credit scores. It's not fair. These news outlets and politicians play too much with our emotions, and I would like to sue for emotional distress. The housing market is shifting. Just look at earnings published by 2 giant Fortune 500 homebuilders. The Federal Reserve actions to fight inflation through higher interest rates continue to impact home buying demand in the fourth quarter. However, that's already old news. Though the first few months of 2023, giant home builders across the country are seeing their fortunes improve as buyer demand stabilizes. Case in point, a pair of home builders on the Fortune 500 list, number 124 D.R. Horton and number 267 Pulse Group, just reported a big drop in cancellation rates. D.R. Horton's cancellation rates for the first 3 months of 2023 came in at 18%, down from 27% rate just 1 quarter earlier. Meanwhile, 13% of Pulse Group's buyers canceled their home contracts in the first quarter of 2023, well below the 32% cancellation rate it saw in the fourth quarter. What's going on? 2 things. First, the national U.S. housing market stabilized this year as we entered the busier spring season. Mortgage rates falling back under 7%, coupled with a lack of existing home inventory, has done just enough to put the market back into equilibrium. Second, home builders have recently gained an edge over the existing resale market. During the pandemic housing boom, a time with seemingly unlimited housing demand, builders achieved frothy profit margins as they quickly raised new house prices. Giant builders like like D.R. Horton and the Pulte Group aren't outliers. Builders from coast to coast are seeing an uptick in buyer demand. Builders surveyed by John Burns Research and Consulting in March had an aggregate cancellation rate of 9%. That's far below the peak of 24.6% hit in October and just slightly above the 8% hit in the height of the pandemic housing boom in March 2022. For perspective on just how much things have improved, Phoenix cancellations hit 60% in November 2022 and are currently at 15%. On one hand, the national housing market has stabilized this spring. On the other hand, housing affordability, or lack thereof, remains at levels not seen since the housing bubble era. In order to reach more priced out buyers, some builders are pivoting from larger single-family homes to smaller townhomes. Here's the real estate development tip of the day. This one comes from a conversation we had in our BTS member group chat. When doing your rehabs, when it comes to the bathroom, it may be tempting to just do a tub and tile reglaze rather than getting a new tub and installing new tile. But keep in mind, if you're doing rentals, reglazes require special care and cleaning instructions that your tenants probably won't follow. And you can look up 6 months to a year later with a peeling tub and tile. And then you're going to need to redo the bathroom anyways. So consider spending a little more on the new tile and a tub to get a better product. It could cost you less in the long run. Okay, that's it for today. Let's get free.